This is not a housing news update. It is an analysis of how governments attempt to re engineer asset markets using two major US housing policy developments as a case study. We will analyze two distinct policy levers. The first is a confirmed proposal to alter market competition by suppressing a specific category of demand. The second is an unconfirmed idea to directly intervene in the credit markets to ease financing costs. The goal is to dissect the mechanics of these policies, how they create new incentives, how those incentives redirect capital flows, and what the potential second and third order consequences might be. This is a framework for understanding how macro level policy can reshape micro level investment strategies. The first policy lever is a concrete proposal from the White House to ban large institutional investors from future purchases of single family homes. This represents a direct intervention on the demand side of the market equation. To understand the mechanism, we must define two key terms, large and future, in ants. The working definition points to entities owning 100 or more single-family homes. This targets the large-scale corporate landlords that operate with significant capital advantages, not smaller-scale local investors. Second, the proposal targets future purchases, not existing holdings. This is a critical distinction. The policy is designed to prevent these firms from acquiring more homes, aiming to level the competitive landscape for other buyers, rather than forcing a mass sell-off which could shock local prices. The core function of this policy is demand suppression. It seeks to remove the most aggressive, price-insensitive bidders from the market, those often making all-cash offers that outmatch traditional financed home buyers. However, the impact is not uniform. Nationally, these large investors own a small fraction of single-family homes, estimated to be under 2%. This has led some analysts to suggest its broad impact would be modest, but national aggregates are misleading. The true story is local. In certain Sunbelt submarkets, institutional buyers can account for 20 to 30% of purchases in a given year, even if their total ownership share remains lower. They focus on starter homes directly competing with first-time buyers. By removing this source of demand, the policy aims to reduce the prevalence of all cash bidding wars, theoretically giving individual buyers a greater chance of success. A potential second-order effect, however, involves new construction. A significant portion of the build-to-rent business model relies on selling entire new communities directly to these large institutional funds. If this major source of capital is removed, builders may lose a key incentive for new projects, which could constrain long-term housing supply and, ironically, exert upward pressure on prices and rents. The final outcome depends heavily on the details, such as whether new construction is granted an exemption. We are about to analyze the second policy lever, which is more complex and speculative. If you find this systems level breakdown valuable for understanding how economies are shaped, subscribe to ensure you don't miss future analyses of critical market shifts. The second development is an unconfirmed rumor about a large-scale government intervention in the credit markets. While the evidence is speculative, the mechanism itself is a valuable case study in how a government can attempt to directly lower borrowing costs. The rumored plan involves having government-sponsored enterprises, Fannie Mae and Freddie Mac, purchase $200 billion worth of mortgage-backed securities. To understand the potential power of this action, one must understand the mortgage spread. Mortgage rates are typically benchmarked against the yield on the 10-year Treasury note. Lenders add a spread on top of this benchmark to cover risk and profit, which has historically been around 1.7 to 2.0 percentage points. Recently, this spread has been unusually wide. A primary reason is the Federal Reserve's shift from quantitative easing, buying large quantities of MBS, to quantitative tightening. When the largest buyer of MBS steps away, demand falls. To attract new investors, the yields on MBS must rise, which translates directly to higher mortgage rates for consumers. The rumored $200 billion purchase would be a form of targeted QE designed to reverse this. By creating a massive new source of demand for MBS, the government would push MBS prices up and their yields down. A lower MBS yield should, in theory, lead to a narrower mortgage spread and a lower 30-year fixed mortgage rate for homebuyers. The potential effect is difficult to quantify, but proponents of such policies estimate an intervention of this scale could reduce mortgage rates by around 30 basis points, or 0.30%. While this may seem small, it would provide a significant boost to affordability for new buyers. This is a brute force method of influencing affordability, not by changing the price of the asset, but by lowering the cost cost of financing it. However, significant questions remain. Fannie and Freddie operate under portfolio caps, which would likely require regulatory changes. Furthermore, the total MBS market exceeds $9 trillion. So the ultimate impact of a $200 billion purchase, while noticeable, may not be transformative. To understand how these macro policies translate to micro level strategy, let's analyze a specific real estate investment model. This is not an endorsement, but a dissection of strategic alignment with policy shifts based on publicly available information about a fund model like that of House Hack Inc. The stated strategy of this type of fund is to find wedge opportunities by acquiring undervalued properties, renovating them, and then renting or selling them for a profit. The model often relies on proprietary software to identify these deals systematically. Now, let's connect this strategy to the two policy levers. First, the institutional investor ban acts as a demand suppression tool. The ban is aimed at large players. A smaller specialized value add fund would likely not be the target. This policy could create a strategic advantage by removing its largest, most aggressive competitors from the acquisition market. In a scenario where a distressed property becomes available, this type of fund would no longer be bidding against multi-billion-dollar institutions paying all cash. This could lower its acquisition costs and increase its margin of safety. Second, consider the speculative credit easing policy. If a large-scale MBS purchase were implemented and successfully lowered mortgage rates, it would directly impact the fund's exit strategy. Its business model involves selling renovated homes to owner-occupants. Lower mortgage rates increase the purchasing power of these end buyers, expanding the pool of qualified customers and supporting higher resale prices. When viewed together, the potential synergy is powerful. The first policy could lower acquisition costs by clearing out competition. The second policy could increase exit valuations by making financing cheaper for the end buyer. This dynamic widens the wedge from both sides. It's a clear example of how macro policy can create powerful tailwinds for a micro-level investment strategy, potentially realigning capital flows towards smaller, value-add investors and away from large-scale aggregators. To recap, we have analyzed two distinct policy levers targeting the U.S. housing market. First, the confirmed proposal to ban large institutional investors is a form of demand suppression designed to alter the competitive landscape in favor of individual homebuyers. Second, the unconfirmed rumor of a large-scale MBS purchase represents a form of direct credit easing aimed at lowering the cost of financing for those buyers. Together, these policies signal a philosophical shift toward actively re-engineering market outcomes, one by managing competition, the other by manipulating the cost of credit. The key takeaway for any investor is the importance of mapping these top-down policy shifts to bottom-up strategic opportunities and risks. This is the same pattern we're seeing across energy, supply chains, and commodities, governments intervening not on price, but on incentives. A strategy that may have struggled against certain market forces could find itself positioned to benefit from new government-mandated incentives. This is a developing story, and the final details of any enacted policy will be critical. If you want to continue tracking how macro policy reshapes markets, ensure you are subscribed. Now, what is your analysis? Will these policy levers achieve their intended effects, or will the unintended consequences dominate? Share your framework in the comments below. Thanks for watching.